Alright folks, let's chat about SCHD, the Schwab US Dividend Equity ETF. It's the hotshot in town, performing like a champ for the past decade. But guess what? There's this little secret behind its success, a secret so hush-hush that most people might not even know about it. In this video, we're going to spill the beans on what sets SCHD apart from other dividend ETFs. We'll show you how a teensy bit of extra effort can unveil a treasure trove of insights that everyone else seems to be missing out on. Plus, we're diving onto a head-to-head showdown between SCHD and its buddies in the ETF world. So, what's the buzz on YouTube and Twitter right now? Well, it seems like everyone's chattering about how SCHD isn't keeping up with the broader market, especially the S&P 500. But here's the deal. Most of the recent gains in the S&P 500 have been thanks to a handful of tech giants like Apple, Nvidia, Google, and Meta. SCHD doesn't have these big players in its lineup, so it's bound to lag, right? It's got its own set of companies, and even its tech exposure is relatively modest at 12.5%. Lately, people have been on the hunt for alternative dividend ETFs, thinking SCHD might not be shining as bright as it used to over the past couple of years. The real question, though, is whether these alternatives are truly alternatives. When folks compare dividend ETFs, they usually check three things: total return, important; expense ratio, also important; and dividend yield. Yes, it matters, but not as much as you'd think, especially if you're in it for the long haul. But wait, there's more. What most folks overlook is how these ETFs pick their stocks. That's the real game changer. Each ETF has its criteria, and SCHD is no exception. They follow the Dow Jones US Dividend 100 Index. You can actually find this criteria stuff with a quick Google search. I know reading ETF methodology PDFs isn't everyone's idea of fun, but it's like uncovering hidden treasure. So, SCHD's criteria are pretty straightforward. US stocks, no REITs, 10 plus years of dividend payments, market cap of at least $500 million, and daily trading volume of $2 million for 3 months. They sort these by dividend yield, but here's where it gets interesting. They don't just stop there. They take the top 50% and then put them through a quality check. It's like the ultimate job interview with free cash flow, return on equity, dividend yield, and a 5-year dividend growth rate as the criteria. Then the cream of the crop, the top 100, gets a golden ticket into the SCHD ETF. But wait, is SCHD's secret sauce still the bee's knees? Well, it's performed like a champ for the past decade, but recent years have been a bit different. ETFs like VIG, VYM, and DGRO have outshone SCHD, thanks to some heavy-hitting stocks that SCHD doesn't have in its lineup. The truth is, SCHD is great if you're after undervalued companies with solid dividends, but it might miss out on the tech giants and the highest flyers. So, in the world of ETFs, it's all about knowing what you want and understanding how they pick their stocks. SCHD is the king of its game, but it might not be the king for everyone. Keep building your portfolio wisely, folks. That's the key to financial freedom. Now, let's dig even deeper into how these criteria can impact your investment strategy. When you're considering investing in an ETF like SCHD or any other for that matter, it's crucial to align your investment goals with the ETF's criteria. SCHD, with its focus on undervalued dividend growers, is a solid choice if you're in it for the long haul and want those steady, reliable dividend payments. However, it's essential to remember that different ETFs have different criteria and they cater to various strategies. For instance, if you're keen on those tech giants like Apple and Microsoft, you might want to explore ETFs like VIG or DGRO, as they include these heavyweights in their portfolios. Now, you might wonder why not just invest in individual stocks instead of ETFs. Well, that's a valid question. Investing in individual stocks gives you more control, but it also comes with more risk. ETFs, on the other hand, offer diversification, which can help spread risk. But don't stop at just one ETF. Diversify your portfolio further by considering other ETFs or asset classes that align with your financial goals and risk tolerance. It's all about finding the right mix that works for you. So, whether you're a seasoned investor or just starting your journey to financial independence, remember this: knowledge is power. Understanding how ETFs like SCHD select their stocks can make a world of difference in achieving your financial dreams. In the ever-evolving world of finance, staying informed and adapting your strategy is key. So, keep building, keep learning, and keep stacking those wins. Your financial freedom journey is uniquely yours, and it's all about making the choices that will help you reach your goals. Thanks for joining us in this video. We hope this deep dive into ETF criteria has shed some light on the fascinating world of investing. Until next time, keep building and stay curious. Peace out.